Okay, let's talk about the global cues. Here's Nigel with the world view.
An extremely weak trading session is what we had on the US markets. The Dow was down close to around 800 points odd. The S&P 500 broke its 200 DMA as well intraday, and that one as well ended virtually at the low point of the day. A couple of factors played out. One was that, in fact, the market was doubting whether or not the US and China, they're going to make peace, and within this 90 days, everything's going to be resolved. And the second factor was the fears of economic slowdown. That's what returned. And that's because, in fact, the bond yields, that was the most crucial part in yesterday's trading session. The spreads, they tightened out there. In fact, we had an inverted bond yield curve that played out. Flattening of the yield curve, basically the 10-year as well as the 5-year yield, that was closing in on the 2-year yield. At one point of time, there's a bit of an overtake as well. So that's the problem. And what does that mean? Well, there's a probability that recession could be around the corner. And that's precisely what Rabobank said yesterday as well. But if that's the fear, then banking stocks, they sold off. JP Morgan as well as Bank of America, both of them were lower. And a couple of those frontliners, they hit 52-week lows as well yesterday. The Citigroup as well as Morgan Stanley, both of them were lower in trade. European markets as well. Today, in fact, there's going to be a holiday because the country will be mourning the death of George W. Bush. So we'll keep an eye out on that factor as well. No cues coming in from the US markets today. But the European markets, they ended in the red. Auto stocks, they did well in the previous trading session. Yesterday, they did come in for some big selling pressure in trade. And if you're looking at the dollar index, that cooled off, but it's still holding above the 97-odd mark. Brent crude price is below that $62 per barrel mark, while Asian markets all in the red today to kickstart trade. And that's why the SGX Nifty is indicating a red start to kickstart trade. Back to you.
All right, thanks a lot for that, Nigel. But let's have an expert advise us before we start trading. Arvind Sanger, Managing Partner of Geosphere Capital Management, joins us on the phone line from New York. Thank you very much for staying up for us, Arvind. Well, just parse this for us. How should we understand this 5-year yield falling below the 10-year yield? What's the danger for the global markets and, importantly, for an Indian investor?
Well, so last week when the Fed governor, when Powell talked about maybe being close to neutral, that was seen as dovish. Now suddenly the bond market is telling us that maybe it's more than dovish, it's concerning. So we've moved from where maybe the Fed getting done, finished tightening being dovish, to where we are now concerned about, between trade war continuing and the economic indicators, certainly from the yield curve going inverted, suggesting that recession is a possible risk. So I think the reality is that in this environment, risk assets are going to be sold, and risk assets around the world are going to be sold because nobody wants to be brave trying to figure out, where the economic tea leaves will lie in terms of who'll win and who'll lose in a global slowdown. So, between trade war and this, I think emerging markets are not going to necessarily outperform in a meaningful way in this environment.
Okay, so emerging markets won't outperform in a meaningful way. It's either this or that, right, Arvind? I mean, we have the yield issue. Before this, we had the trade issues. But in hindsight, some of these issues have been the best buying opportunity for Indian investors. At least we've seen that play out over the past few months. You think things would change now?
Well, I mean, a bull market, every dip is a buying opportunity till the bull market ends. So, eventually every bull market has an ending, and then there's a major crash, and then, you buy it. So the question is timing is everything. What you do have in India right now is you have the benefit of lower oil prices. You have state election results that are coming out in a few days' time. So that's an overhang on the market. And you have, potential kind of the easing of a little bit of the super tight financial conditions that had developed as a result of the NBFC, tightness. And I think RBI is probably most likely going to be in a much less hawkish tone. So, you have a huge number of cross currents. I don't think the markets are going to run away, but I think the markets are going to be circumspect. And I continue to remain of the view that we're not going to get a huge rally, but I think a selective buying opportunity in companies with, visible earnings. India is somewhat immune to, or many of the companies in India are somewhat immune to, global growth. They're not dependent on global growth. So I think those are some of the positives.
Arvind, good morning. So, are we still in bull market? That's the first question. And if yes, you think this correction has given good opportunity in the broader market in particular?
Yeah, I'm of the view that recession is not around the corner, but I'm of the view that, the one thing that I am coming more and more convinced about is that the trade war issue with the U.S. is structural. And the U.S. is not going to back down easily. And the pressure on China is going to continue. And the rhetoric on that is going to remain an overhang on the market. Because, at the end of February, on March 1st, our tariffs going to go up to 25% on Chinese imports. So those are real risks for the market that will create volatility and that will create headwinds. So I don't think the bull market is going to resume, but I don't think we're going to a recession. So I think the market's going to be much more choppy, and it's going to require a strong stomach, or it's going to require long-term views on select companies, because I think the market itself is going to remain range-bound. And now I'm talking about the U.S. market. I think emerging markets will follow in some respects from that. Certainly, China will be very, very range-bound for that reason.
Okay, at what point will you buy in India, and what will you buy?
Well, I would wait till for the election results, and assuming that there are no nasty surprises. I think there are, companies, as I've been saying recently, with the easing of the, fiscal concern and the current account concerns with the oil having pulled back as much. Remember, there's an OPEC meeting this week, but I don't expect that OPEC meeting to result in any sharp rise in oil prices, because shale production in the U.S. is so strong. So therefore, I would say that, domestic-oriented companies maybe more with a rural bent, given that there's an election coming up. But domestic demand stories, which are reasonably priced, would be where we would be looking for opportunities. Some of the domestic infrastructure plays would be interesting.
Okay, Arvind, we leave it at that. Thanks so much for joining us and giving us your quick take. So that's a circumspect view on emerging markets. He says the growth scare is really spooking investors now, and he doesn't see the bull market resume in a big way.